Harry was 29 years old, sitting in a rental apartment with student debt, car payments, and a savings account that had $1,200 in it. He made $52,000 a year after taxes, spent around $3,400 a month to survive, and had maybe $800 left over when the dust settled. Someone told him that if he invested that $800 every single month, he could retire in 12 years. He didn't believe it. But something made him open a spreadsheet anyway. Most people hear a number like that and assume there's a trick, a side hustle, a crypto bet, an inheritance. But what Harry found wasn't a shortcut. It was a pattern so boring, so predictable, that it scared him more than failing ever did. Because if it worked, it meant he'd been wrong about time. And if he'd been wrong about time, he'd been wrong about almost everything else. Harry didn't grow up with money. His parents worked stable jobs, paid their bills, and retired at 65 with enough to get by. That was the blueprint. Work until you're old, then stop. The idea that someone could step off the treadmill at 41 felt like fiction. But Harry had started noticing something. People around him who seemed calm, who didn't talk about money, who drove older cars and wore the same jacket for years, they were the ones who disappeared from the office first. Not loudly. Quietly. And when he asked one of them how, the answer was always some version of the same thing. Start early. Stay consistent. Let math do the work. So Harry ran the numbers. $800 a month. 12 years. He assumed a 7% average annual return, which historical data suggested was conservative for a diversified stock index fund. He plugged it into a compound interest calculator and stared at the result. After 12 years, he'd have contributed just over $115,000 of his own money. But the account would be worth around $163,000. That wasn't enough to retire on. Not even close. But then he adjusted one thing. He assumed his income would grow. That every year, he'd increase his contribution by just 5%. Suddenly, the number jumped. By year 12, his monthly contribution would be around $1,400, and his total balance would push past $210,000. Still not retirement. But then he saw the next part. The part most people miss. Month 1 was silent. Harry set up an automatic transfer from his checking account to a brokerage. Every dollar went into a low-cost index fund. No stock picking. No timin. No apps with green and red arrows. Just a fund that tracked the entire market. He didn't feel different. He didn't feel smarter. He just felt like he'd pressed a button and walked away. His friends were buying new phones, booking trips, talking about raises they'd spend before they arrived. Harry kept his phone for another year. He didn't announce what he was doing. He didn't post about it. Because the moment you talk about money, people have opinions. And opinions create noise. And noise kills patterns. By month 3, Harry felt stupid. The account had grown to $2,400, but the market had dipped, and his balance showed $2,350. He'd lost money. Technically, he hadn't lost anything, he hadn't sold, but it felt like loss. His brain wanted to pull out, to wait until things looked safer. But he'd read something in a book by Morgan Housel about how the cost of investing isn't fees or taxes, it's emotional volatility. The price you pay to build wealth is watching your account drop and doing nothing. So Harry did nothing. He left the transfer on. He didn't check the app. He treated it like a bill he couldn't skip. And something about that reframe made it easier. By month 9, he'd contributed $7,200. His account was worth $7,680. A $480 gain. It didn't feel like magic. It felt like watching paint dry. His coworker bought a new car. His sister renovated her kitchen. Harry kept driving his 2012 sedan and eating lunch he packed the night before. People started asking if he was okay. He said he was saving for something, but he didn't say what. Because if you say you're retiring early, people either laugh or start explaining why it won't work. And Harry didn't need to defend a pattern that hadn't proven itself yet. He just needed to protect it. Then year 2 arrived, and something broke. Harry's transmission died. The repair was $2,300. He had an emergency fund, barely, but using it meant pausing his investment. He felt the pull. The voice that said, "See? You can't do both." Life always wins. But Harry had been reading about identity. Not goals. Not motivation. Identity. He'd started thinking of himself as someone who invested every month. Not someone trying to. Someone who did. And when you operate from identity, the question isn't whether you'll do it. It's how. So Harry fixed the car with the emergency fund, picked up 2 freelance gigs that month, and kept the $800 transfer alive. It hurt. But it didn't break him. And that was the test. Because wealth isn't built in the months when everything goes right. It's built in the months when everything goes wrong and you don't flinch. By year 3, Harry's balance had crossed $32,000. He'd contributed around $29,000, which meant the market had added $3,000 he didn't work for. That was the first time he felt it. The shift. The moment when compounding stops being a concept and starts being a presence. His money was making money. Not a lot. But enough to notice. Enough to make him realize that if he stayed consistent, there would come a day when his investments earned more in a year than he could save. That day wasn't close. But it was real. And for the first time, retirement at 41 didn't sound like a fantasy. It sounded like a schedule. This is where most people expect the story to explode. The part where Harry discovers options trading or starts a business or finds a mentor who changes everything. But that's not what happened. What happened was boring. Harry got a raise. 5%. He immediately routed the entire raise into his investment account. His lifestyle didn't change. His rent stayed the same. His car stayed the same. His friends assumed he was still broke. But his monthly contribution had quietly climbed to $880. Then $920. Then $1,050. Nobody noticed. And that was the point. Because stealth wealth isn't about looking poor. It's about looking normal while the gap between what you earn and what you show grows wider every year. By year 5, Harry had $78,000 invested. His contributions were up to $1,100 a month. He'd automated everything. His paycheck hit his account, bills pulled automatically, investments pulled automatically, and whatever was left went to living. He didn't budget in the traditional sense. He built a system where the right things happened first, and life fit into what remained. His friends were talking about buying houses, about leveraging debt to build equity. Harry didn't argue. He just knew that every dollar he didn't lock into a mortgage was a dollar that could compound. And compounding was the only leverage he trusted. Year 7 was the year Harry crossed 6 figures. His account hit $102,000. He'd contributed around $95,000 total, which meant the market had handed him $7,000 in growth. But here's the thing nobody tells you. Crossing 6 figures doesn't feel like winning. It feels like the beginning of a different game. Because now the stakes are real. Now a bad year doesn't cost you $1,000. It costs you $10,000. And your brain, which spent years ignoring small drops, suddenly pays attention. Harry had to relearn the same lesson at a higher altitude. Don't look. Don't react. Stay boring. By year 9, his balance had reached $145,000. His monthly contribution was $1,350. And this is where the math starts to bend. Because at this point, his portfolio was generating around $10,000 a year in growth, assuming that same 7% average. That's $10,000 he didn't have to work for. And while that number would fluctuate wildly year to year, the trajectory was clear. His money was starting to work harder than he did. Not louder. Not faster. Harder. And the gap between effort and outcome was widening in his favor. Year 11 was the inflection point. Harry's account hit $190,000. His monthly contribution had grown to $1,500. But something else had shifted. He'd spent a decade living below his means, and it no longer felt like sacrifice. It felt like protection. His life was simple. His expenses were predictable. His income had grown, but his lifestyle had stayed flat. And that gap, that beautiful invisible gap, was now a moat. He didn't need to retire at 41. He could. And that difference between need and could was freedom. By year 12, Harry's investment account held $218,000. He'd contributed roughly $168,000 over the span of those 12 years, and the market had added another $50,000. His monthly contribution was now $1,600, and his annual expenses were still under $45,000. At a 4% withdrawal rate, his portfolio could theoretically generate $8,700 a year. That wasn't enough to live on. Not yet. But here's the part that rewrites the story. Harry didn't stop. Because the pattern that got him here didn't require his attention anymore. It required his absence. And if he let it run for just 3 more years, his balance would cross $300,000. 5 more years, and he'd be over $400,000. At that point, a 4% withdrawal rate would cover his entire lifestyle. And he'd be 44 years old. But even if he stopped contributing at year 12 and let the $218,000 sit, it would double roughly every 10 years at 7% growth. By the time he was 51, that account would be worth over $430,000 without adding another dollar. Everyone's situation is different, and past performance doesn't guarantee future results. But the math is public. The strategy is simple. And the people who quietly disappear from the office before 50? They're not lucky. They just started earlier and stayed boring longer. Harry proved it. And if he can, so can you.